strive for perfection. Be the best in what you do. Be extraordinary. Well, not in personal finance and investing. Investing is one area where average is good. No, average is great. Average is extraordinary. In fact, pursuing above average returns is a futile exercise. Let me explain why. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder, and I've helped dozens of women take control of their financial futures. Subscribe to my YouTube channel and follow my Facebook page to get all the latest videos on building your wealth through investing. In this video, I will tell you why you should aim to be an average investor, especially if you don't have a very high net worth. There is one area where this may not work, and I will talk about that towards the end of the video. I looked at 3,500 different US large cap domestic funds from the past century. About 1,000 of those funds no longer exist. Only 900 out of the remaining funds have a 10-year or longer performance history. Out of those 900, only 100 funds have outperformed their benchmark in the past 10 years. Out of those 100, only 12 funds have outperformed their benchmark in the past 3 and 5 years. That's just 1.3% of the funds with a 10-year or longer performance history. Now, if those guys with years of training, experience, and state-of-the-art tools at their disposal cannot beat the market, what makes you think that you can do better? Now, it's a different story with institutions because they have the power to negotiate lower fees that can eat into the returns, and they also have tremendous amount of manpower and tools to look at stocks, industry, and follow the market on a daily basis. So what do when you can't beat the indexes? You join them. That's exactly what the efficient market hypothesis tells you. When markets are efficient, as they are in the United States, every single piece of information about the economy, industry, stock gets quickly priced into every single stock. So it's impossible to buy and sell individual stocks and make a return that's higher than the index. And remember, when you buy individual stocks, you have to be right twice. Once when you buy the company, and second when you sell the company. Also, when you buy only a handful of stocks, you're making a conscious decision of not buying the remaining hundreds or thousands of stocks that are in the index. And by doing so, you have to be right about the industry, the sector, and the company too. Which is why I highly recommend investing in indexed funds. And I will tell you what they are in a minute. The idea is, instead of hiring an active manager to buy and sell individual securities or even doing it yourself, you go out and you buy an indexed fund. There are many different types of indexed funds that try to replicate the return of the index that they're indexed against. Now that's a lot of index. Let me explain with an example. The Vanguard S&P 500 indexed fund replicates the holdings of the S&P 500 index. So if you own one share of this indexed fund, you own roughly 500 stocks that are part of the index in the same proportion as they are in the index. And this you can do at a very reasonable price. You don't have to worry about which stock will perform better, which industry will perform better, or which sector will perform better. You will earn a return that's very close to the index's return minus a very small management fee. Here are some advantages of using indexed funds. You don't have to worry about spending time researching different investments and then trying to time them. Your time is best spent doing what you truly enjoy doing and what you're good at. You get to keep a lot of your money because you're not paying very high fees that active managers can charge. Some managers can charge between 1 and 3% of the total assets that are invested, while some index funds charge less than 0.1% of the assets that are in the index fund. You automatically get a well-diversified portfolio of hundreds of holdings without having to manage that allocation yourself. And while you don't make the best return, you also reduce your risk of making the worst possible return on your investment. You don't have to keep monitoring your indexed fund manager as you do your active manager, because if one manager leaves, he or she will get replaced by another manager, and managing an index fund does not require a lot of skill. And if fear or lack of skill is holding you back from investing, indexing is your best bet. Obviously, there are no guarantees in life, but investing in an indexed fund is by far the superior way for an average investor. If you like what you've heard so far, don't forget to hit the like button. And if you haven't already, click the subscribe button and then click the bell icon so you don't miss any of my videos. If you're watching this on Facebook, don't forget to follow my page. I post a new video every week. And to help you better allocate your resources, I've linked my personal budgeting worksheet in the description below, so don't forget to grab that. Here are a few things that you should pay attention to before you buy an index fund. First is the choice of fund, whether it's a mutual fund or an ETF, which is an exchange traded fund. Vanguard, for example, has both an S&P 500 mutual fund and an S&P 500 indexed ETF. The mutual fund may have some minimums, and it does not trade on an exchange. It trades only once at the end of the day closing price. So if you cannot afford the minimum, the ETF may be the route for you. ETFs trade throughout the day on an exchange. There are no minimums. Some mutual funds may allow you to automate your investments. So basically you can draw out a certain amount each month from your checking account and deposit and invest directly into the indexed mutual fund at the end of a month or a quarter, depending on your timeline. ETFs do not offer that option. If you want no hassle and want to automate your investment, mutual fund may be the route for you. Other than that, there are no big differences between the mutual fund or the ETF that affect an individual investor. Second, the index itself. There are many different flavors to index funds. There may be bond funds, stock funds, REIT funds, you name it. Bond funds typically generate income, which is then taxed at your regular income tax rate. I prefer to hold bond funds in tax-advantaged accounts, such as my retirement account. Stock funds can be held in your regular brokerage account. If you want to invest in international markets, you can invest in an international index fund. There are also sector funds or industry funds and very specific niche funds. And third, and the most important one, is costs. Since index funds are passive, those managers don't need to be compensated for picking superior stocks. So choose funds that have low fees or expense ratios. Check out the link below where I discuss mutual fund performance and how fees affect performance. You will be surprised to notice that even a few basis points in fees can affect your returns by a big number over the long run. I will discuss mutual fund fees and performance in my next video, so stay tuned. Having said that, am I saying that there is no value in hiring an active manager or picking stocks? Of course not. There are times when indexing may not be your best option. This is true in less efficient markets such as international markets. Let me explain. If you look at the US large cap market, all stocks that are in it are followed by hundreds of analysts. So any new piece of information is consumed quickly by these analysts, who then incorporate this information into their models almost instantaneously. There are algorithmic platforms, basically large computers with software that can consume any piece of information and trade within a fraction of a second on that new information, so that price of those stocks get adjusted almost instantaneously. So there is no time for you or me to take advantage of any new information that becomes available and generate a better return. But there are some inefficient markets such as international markets or even the US small cap markets that are not as closely followed by analysts. This is where active management can really add value. Remember, as an individual investor, you will almost always pay higher fees than an institutional investor who can negotiate a lower fee structure. And as an individual investor, you may not have access to the institutional share class, where the minimum investments are higher and maybe out of reach for some individual investors. So even in inefficient markets, indexing may be your best bet, and it will save you time and effort required to hire an active manager and monitor them. If you do decide to go with an active manager, make sure all your investments are not in one basket. Check the track record and make sure that you are not paying for uncompensated risk and that you understand all the risks associated with active management. Making well-diversified indexed funds a significant portion of your portfolio is a wise strategy. I will talk about mutual fund fees in my next video. Make sure to subscribe to the channel and hit the bell icon so you don't miss it. That's it from me this week. As always, don't forget to be happy, to be kind, and to be your best self. Bye! And here are some more videos I think you will enjoy. I would really appreciate your hitting the like button and sharing this video with your friends and family. It will help me reach more people.